Many of you have asked me to review UNH in this video, United Healthcare. This is what I'm gonna try to do. It's down over 15% on the year, and with such high quality companies, as you can see from the charts, these stocks pretty much keep going up. They spend most of their time close to all-time highs, and now UNH is 15% off its all-time high. And I'm gonna try to analyze in this video UNH and try to find out if this is an opportunity for us to maybe pick up one of those high quality winners that are 50% of their highs, or is it still hyped up, is it still very, very expensive, and maybe we should wait for a better price. Now, most of you are familiar with UNH, but they have different components within their business. 78% of their sales is from United Healthcare, which is where they collect the premium. Most of you are familiar with that. But then their three segments are around Optum, which was very interesting to me because I never really analyzed UNH. Optum RX is 12%, Optum Health is 9%, Optum Insight is 2%. And I tried to look up what are those Optum type of components. And Optum Health is more around, clinics, virtual, in-home and digital type of care. Optum Insights, which is growing very, very fast. It's a very, very interesting area. And it's more around the technology behind all those things, more around data and analytics and things to kind of make healthcare much easier, much more accessible, and to collect a lot of data and try to do something with it, which is very, very interesting. It's growing very, very fast. And they have like a $40 billion backlog, which is a pretty amazing thing from UNH. And then the last component of their business is Optum RX. And this is mostly around pharmacies and, prescription drugs and stuff. And Optum RX serves more than 61 million people. UNH is one of the most popular healthcare companies in the United States. They have a deep moat, and this is one of the reasons why the stock just pretty much keeps going up. They have a moat, they have high return on capital, which we're gonna talk about, and this is really what makes an amazing compounder like UNH. And Optum is growing very, very fast. They grew over 25% to $54 billion, and the operating earnings grew 19%. This is how much this company is growing, even though it's something like $300 or $400 billion. I mean, this company is still growing 10, 15, sometimes 20% in a single year, which is pretty amazing with UNH. But most of you actually know that I prefer looking at the numbers more than I prefer looking at the business itself. And the numbers are actually looking very good with UNH. Looking at the recent earnings report, I remember looking at it before. The revenues is up from $80 billion to pretty close to $92 billion. Their net earnings are up from $5.1 billion to $5.7 billion. And I remember the stock selling off like 8 or 10% in a single day. And I was very surprised on why the market is just rallying in and it's selling off United Health, which is still selling off actually, and it's pretty interesting to me how sometimes the market can be so irrational. But the income statement looks good with UNH. Looking at the balance sheet, some concerns I have on the balance sheet. Their current assets are around $93 billion. Their current liabilities are $116.5 billion. And normally I like the companies to have more current assets than current liabilities just to satisfy their short-term obligations. But whenever this company like UNH has higher, short-term liabilities than short-term assets and cash on cash, I try to look at the free cash flow and see if the free cash flow is actually sustainable. And in terms of UNH, it's generating over $27 billion every single year of free cash flow. So the difference between the current assets and the current liability does not really worry me with UNH because they generate so much free cash flow and it's very, very sustainable, and it's even growing pretty much every single year except 2021, which gives me more comfort around the current liabilities being more than the current assets. And they have around $60 billion of, around long-term debt and, maturities and stuff, which I still don't believe they are a big of a problem with something like UNH generating almost $27 billion every single year. I don't think the debt is a big of a problem with UNH. Now, looking at where UNH is trading at right now, it's trading around 18.5 times earnings, forward earnings, which is actually not really bad bad at all with a company that has around 18 or 19% return on capital. Now, if the return on capital was 3 to 4%, I would say UNH at 18.5 times forward earnings is very, very expensive. But because it's such a high quality company and they earn high sustainable returns on capital, I don't believe 18.5 is actually expensive for, something like UNH. Now, if you look at this chart of their historical PE ratio, their mean was 18 and it traded as low as 11 times forward earnings, and this was pretty much in March 2020, which we're not going there. But if you could ever buy UNH at 15 or 14 times, forward earnings, it would be amazing. And normally it tends to go this low whenever we have an election, because on elections here in the United States, you have a lot of political parties trying to come up with a plan to have universal healthcare, which is pretty much never going to get passed. But it still is not going to get passed. But UNH just sells off every single time. It happened in 2020. It happened in 2016. Every time they come up with some kind of a universal healthcare plan or whatever, UNH goes down, even though most people know that we will pretty much never have universal healthcare in the United States because of the political donations and many other things that happen. So I don't believe it's as big of a threat. Of course, it's a big risk if someone ever decides to do it and then Congress passes it, which is unlikely. But if that ever happens, it's very, very severe for something like UNH. But normally the best time to get UNH is actually on election years, and we're having one in 2024. So maybe then UNH could be at 15 or 16 times earnings. I mean, we really don't know, but we don't know where earnings are going to be then, so it could be much higher than it is right now, which is why I'm going to try to look at my valuation model to try to determine if UNH is actually undervalued at such prices or not. Now, looking at the revenue growth, I have 13% for 2023 and 8% sustainable from 2024 to 2027. And this is based on the analysts' estimates that I used. They have around 13%, which is the guidance of UNH, and then between 7 to high 8. So I have 8% sustainable from 2024 to 2027. Now, I have to remind you that what I used here is actually much lower than their own outlook, because their own outlook is something between 13 to 16% in terms of EPS per share growth. And for me, in terms of revenues, I only have 8%. So it could be much, much higher with buybacks and stuff, and I tried to factor it in. Now, their net income margins are 6.5%, so I kept them at 6.5%. PE ratio, I put it at 20. And the reason I put it at 20 is because trailing earnings, not forwards, the trailing earnings are now at 22 times earnings. And the mean for UNH over the past 10 years was around 20 times earnings. So I used the mean in this valuation model of 20 times earnings. And I used a 3% dividend, which is 1.5% dividend and 1.5% in terms of share repurchases every single year. So it's around a 3%. I got around 60% on the upside, or 11% compounded every single year for the next 5 years. And this is actually not a bad return at all. I don't think it's bad at all. I mean, the S&P returns 8 to 9% every year, and then you're getting 11% with a compounder like UNH. It could end up being much, much higher. But for me, it's not, the best bargain in the world, in my personal opinion. Many of you know I did many analysis on other companies, and I said CVS is one of the most undervalued ones, and I do believe that. But CVS is more of a deep value play. UNH is more of a longer-term hold, compounder, type of play. And in terms of my valuation model, I have to buy UNH at $400 per share to get it double over the next 5 years. And $400 per share would be somewhere actually where it pretty much was, in late 2021, which is not very far from here. It's, I believe, around 12 or 13% to the downside, which could happen in one earnings report. So we might easily see $400 per share on UNH. And I believe at $400 per share, UNH would be an amazing buying opportunity. But we might not see it because these compounder type of stocks, they keep sitting at all-time high, they keep going up. But for me personally, I have a price alert at $400 per share for UNH. If it ever goes there, I will enter a position and maybe hold it as a very long-term investment. I might change my mind, but this is what I have in my own watch list at $400 per share. But if you're really desperate to buy UNH at such prices, it's not really the worst deal in the world. But for me personally, I like it at $400 per share or below. So thank you for watching this video. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another one.